Welcome to The Explainer. Today, we're going to peel back the layers and find out what really makes a company tick. And hint, it's not the daily stock price. It's a secret that's hidden a little deeper in its operations. All right, let's just jump right in with the big question that every single investor has on their mind. When you're looking at a company, what's the one thing you really need to understand to know if it's a winner?
Well, let me tell you what it's not. It's definitely not that number you see flashing on your screen all day, the stock price going up and down. That's just, well, it's noise, It's a symptom, not the actual cause of a healthy business.
Nope, the real secret, the thing that tells you if a company is truly strong, it's all about how it runs its business behind the scenes. And it really just comes down to two things: how well it uses its stuff and how smart it is with its cash. So, first up, let's talk about that first piece of the puzzle, the efficiency engine. And we've got this really great metric for it called asset turnover. The idea here is actually super simple. Think about it. For every single dollar a company has tied up in its assets, we're talking factories, machines, you name it, how many dollars in sales can it actually squeeze out? And yeah, you guessed it, the higher that number, the better. Here's a great way to think about it. A taxi, right? The car is the asset. Now, if that car is just parked all day, it's making zero money. But a taxi that's constantly picking up fares, that is a high turnover asset. And that's exactly why drivers sign up for services like Uber. It's all about getting more trips and maximizing that asset turnover. Okay, so that's efficiency. But what about the second piece? Cash. Oh man, this is so important. You can have the best sales in the world, but if you mismanage your cash flow, you are in big, big trouble. And that brings us to something called the cash cycle. So let's say you start a t-shirt business. Day one, boom, cash goes out the door to buy your fabric. Then it takes, 10 days to actually make the shirts, and then another 20 days to sell them all. See what's happening? Your money is tied up for a whole month before it finds its way back to your pocket. Right, that 30-day gap, that's your cash cycle. And honestly, a lot of businesses really struggle with this. But the absolute best companies, the superstars, they figured out how to get that number down to zero, or, believe it or not, even make it negative. Okay, check this out. Let's put this into perspective with a real-world example. You've got a giant, Hindustan Unilever on one side, and a struggling penny stock on the other. For every 1 rupee of assets, HUL cranks out 22 rupees in sales. The penny stock? A measly 2 rupees. That difference in efficiency is just wow. But hold on. The cash cycle is where it gets truly mind-blowing. Get this, negative 52 days. Just let that sink in for a second. Whole gets paid by its customers almost 2 months before it even has to pay its own suppliers. That is just incredible. It's basically running its entire operation on free money from its partners. That's what you call serious market power. Okay, so now we know that a company's real health comes from its operations, right? But it's so easy for investors to get sidetracked by all the flashy headlines that, frankly, don't mean much. So let's talk about one of the biggest distractions out there, the stock split. So you wake up, you check the news, and bam! The company you invested in just announced a 2-for-1 split. You had 100 shares, and now you're going to have 200. That feels amazing, right? It feels like you just got richer. But did you? Let's break it down. Imagine the whole company is a pizza, and it's cut into 5 big slices. Your 1 share is one of those slices. You own 20% of the entire pizza. Simple enough? Now, after the split, it's the exact same pizza. No extra toppings, no extra cheese. All that's happened is that it's now been cut into 10 smaller slices. So yeah, you have 2 slices now, but add them together and you still only own 20% of the pizza. Nothing's really changed. And that's the absolute key takeaway here. A stock split doesn't make you any wealthier. The company isn't suddenly worth more. All it does is make each individual share cheaper, so it's easier for more people to buy and sell. It's about liquidity, that's it. It tells you absolutely nothing about how well the business is actually doing.
All right, so if a split is an illusion, what about its close cousin, the bonus share? I mean, come on, the word bonus is right in the name. It's got to be a good thing, right?
So the company says, hey, for every 1 share you own, we're giving you another one for free. Wow, sounds fantastic. But again, let's look at the math and see what's really going on with the company's value. And yeah, there's a catch. Of course there is. The company can't just magically create money out of thin air. The total amount of money in the company, the shareholders' fund, stays exactly the same. So if you double the number of shares floating around, you have to cut the value of each share in half. It's just simple math. So if splits and bonuses don't actually make you richer, why on earth do companies even bother? Well, it all boils down to one simple concept: affordability. And to really get this, we have to talk about a company that does the exact opposite. I'm talking about the legendary Indian tire company, MRF. Have you ever looked up its stock price? It's kind of famous for this. Yeah, that's not a mistake. We're talking about 57,000 rupees for one share. I mean, think about it. That crazy high price tag automatically locks out tons of regular investors. Most people just can't afford to buy in. And why is it so expensive? The reason is super simple. In its entire history as a public company, MRF has never ever done a stock split or issued bonus shares. So what splits and bonuses are really for is the opposite of this. They're tools to keep the share price in a range where everyone can afford to participate. So here's the bottom line. The next time you're looking at a company, I want you to try to ignore all the noise, the day-to-day price jumps, the headlines about stock splits. Instead, dig deeper. Look for the real secrets. Look at its asset turnover. Check out its cash cycle. Because when you start to understand the engine that's running the business, that's when you stop being just another person guessing in the market, and you start becoming a truly savvy investor.